Hello, everyone, and welcome to NP Capital's Small Business Essentials series, where NP will share tips to help your small business thrive. Today, we have a riveting discussion ahead of us with NP Capital's founder, Nick Desai, and Abe Kamarck, a Seahawk helicopter pilot turned London Business School MBA turned TrueMade Foods founder. A partnership gone south led TrueMade Foods into a bankruptcy situation, but he managed to keep the business alive with a little-known code called Subchapter V. Nick and Abe will talk about Abe's story, his options, and how he managed to keep his equity throughout the bankruptcy process. So without further ado, I'll turn it over to Nick.
Thank you, Hannah. Yeah, really excited to talk to Abe today. What a special treat, to hear from a founder and, of course, a pilot, which is my original dream, by the way, but my eyes were bad. So I think, what we're really excited to talk about is the fact that there is this tool that I think is not that commonly known to founders, and unless you have a legal background or more sophisticated restructuring background, which is rare among founders, that can be very effective in helping resolve situations when you may be facing the threat of bankruptcy. Um, and there's certain key advantages to it. It was designed by Congress for smaller businesses. And we'll get more into that as we go here. But I want to start with just a little bit of Abe's backstory, and his path, and giving him an opportunity to talk about that a little bit. So, Abe, why don't you tell us a little bit about your path to founding the sauce company that you did, and some of the things that you went through, and some of the things that led up to the challenges that you ultimately faced.
Yeah, I mean, I thanks for having me, Nick. This is great. Want to help people here. Um, a little bit of a strange backstory. It took me to founding TrueMade Foods, but yeah, I was a Navy pilot for quite a few years and lived overseas. And while I was overseas, I got my MBA at London Business School. Got into entrepreneurship, mainly working in emerging markets. Initially, I lived in Bulgaria. I ran a plastics factory, and then I ran my own company in Doha, Qatar, for a few years, and worked in all over the Middle East and Africa. That got me into kind of more of a social impact and social entrepreneurship field. And so when we moved back to the US in 2013, I was hired by a charity that wanted a kind of a in-house entrepreneur to help them launch social impact products, right? So I worked on a coffee, like a social impact coffee for them, and developing it and importing it out of Africa and getting it, working with the collective and the cooperative. And then as I was getting that launched and developing it, and this was my first exposure to CPG, and this was like in the early 2010s, 2013 to 2015. And I was really excited by what I was seeing in CPG, and I really kind of enjoyed having a product and seeing the impact a product can make in people's lives and in the supply chain and so on. So in 2015, the charity kind of went under. They ran out of money, started giving people severance. And even though the coffee we were doing was doing well, there was a lot of other parts of the charity that was not doing well, not managing well. And so I took the severance and I used it as an opportunity to launch TrueMade Foods, because I saw this real opportunity here in CPG at the time. Things were really hot. In 2015, there were a lot of acquisitions happening, and everybody was saying that there's going to be a move towards healthier products and healthier eating, which is something I was obsessed with at the time. And at the time, I had four young kids, and they were all pouring ketchup all over their food, and it was driving me nuts. And so I thought, I'm going to stop losing the battle at the dinner table, arguing with a 5-year-old over ketchup, and win the war. And so I created a better ketchup, kind of falling back on how my grandma and great grandma used to cook, using vegetables and fruit to naturally sweeten things. So we created a no sugar ketchup that used only fruits and vegetables like carrots and butternut squash. Kids loved it. Everybody, all the kids who tried it loved it. In fact, the 5-year-olds ate it. So I saw a great market opportunity here, and so I pushed forward with that. And in 2018, I partnered with world famous pit masters from North Carolina and Ryan Mitchell, and we launched barbecue sauces in 2020 as well, and kind of grew up from there. We kind of followed like we tried to follow a very rapid and growth curve, because that's what was happening kind of pre-COVID. And one way that and anyway, it was very difficult, and I was not as good at raising money as like many other competitors out there, like a Sir Kensington or something. So I didn't have that personal network, so we were always a little bit behind. And one way I found as so I was always looking for a way to get ahead. One way I found was an investor approached me about doing a partnership with a very large candy company in New Jersey, and this the whole partnership was based on that they would give us working capital, unlimited working capital, and provide all our logistics in return for warrants in the company. So I thought this
Mhm.
was a great deal because this would allow us to really kind of explode. And it did. Like the first year we did it in 2020, we were able to over double sales. We went from 1 million in sales to over 2 million in sales just that year. We expanded nationally,
Wow.
and we launched, 4 new SKUs because, we had the working capital, we had the logistics support. So we just like went all in, and we signed contracts to launch in Major League Baseball stadiums as well. So we decided to expand into food service as well. So we went like full in, like we're going to grow really hard now because we have this working capital line. We have this logistics support. So that worked really well for like 11 months. And then out of nowhere, without any warning, and without any indication, um, the contract got killed. They seized all I was called one morning on a Monday, and the warehouse manager told me she didn't know why, but she said she was being told not to fulfill any of our orders and to not let any of our products go out. All of our products, about $260,000 worth of product approximately, got seized. We didn't have access to it. I didn't know what was going on. It took about 5 days before I heard anything. And I only heard then from a lawyer at that point. I still don't know exactly what happened. But just to give context for everybody out there and other founders, like we did everything right. We were following the contract. We were making any payments that needed to be made. We were communicating. We were over communicating. All of our staff. We were following the strategy that we had agreed to. All of these things. And I think, this large company, somebody at this large company decided that this was a bad deal and that they didn't want to do this anymore. And they thought the easiest way to get out of it was just to kill it overnight and not try to, eke it out. And so that's what they did. And we were stuck, and they didn't want to deal with us. So they hired an outside lawyer to deal with it. And we were stuck dealing with this outside lawyer who refused to negotiate on anything. And so just through pure sheer will, and a lot of innovative thinking, we were able to survive by like moving things around quickly, getting our co-mans to start producing more product quickly, and moving it, starting to sell directly from the co-man to a few of our distributors, allowing some of our distributors not to pick up but to go to delivered. And so we could move around. We quickly found another small warehouse in Philadelphia, jumped into that. We lost probably about 60 to 90 days of sales. We lost all our growth momentum. We lost 2 huge contracts with 2 major retailers. And the worst part about it was like we fell into like kind of a unprofitable kind of spiral because, as 2021, you saw inflation prices rising like crazy, and we didn't have the margins built in for logistics. Like we were getting free logistics support, warehousing, fulfillment, freight, all that kind of stuff. So our margins were not built to now all of a sudden work with 3PL and do that. And so we had to start raising prices, and we were not keeping up with inflation. And so we quickly started losing money, significant amount of money. And it was hard for us to judge that. That didn't kill us though. That didn't put us into the thing like that. It was about 2 years of that, of struggling through this, trying to figure out what was happening, getting stable. And when we finally figured out how to get stable, how to get great logistics partners, great logistic partnerships, and work through this and get our margins back. And we grew our margins from 15% to 50% in just a couple of years. And we were back and starting to get profitable again. And then right as that was happening, we got a notification from a lawyer that this old candy company was suing us for the
Wow.
balance of the working capital that they thought they owed us, minus what they sold of our products on market. So it was
Right.
about $300,000, which was for us, after going through everything we did, was just might as well have been like $30 million, right?
Right.
So, um, and unfortunately, I think you get into these situations typically. And if you're many times when you talk to people about this, they say that's ridiculous. Why would they sue you? It doesn't make any sense. They're going to waste more money on lawyers. It's a rounding error for this billion-dollar firm. And the problem is like our legal system is set up to reward irrationality sometimes, and sometimes you just run into irrational people who don't have all the information, who are trying to make who are making emotional decisions. And if they have the money
Right.
to do that, they can do that, and they can really ruin your life. Um, which is why
Well,
communication is
the
always
bottom line is
important.
you hit this cash wall, right? You cash flow
Right.
challenge, like, and that's something that we hear often from founders, right? Whether it's a lawsuit related issue or an issue relating to working capital being tied up, which the business you're in, CPG world, is such a working capital intensive business. The companies then start running low on cash, then they go to borrowing, right? It's a common theme and cycle we've seen many times. What were your options at that point? What were you contemplating and how were you looking to get out of it?
So we spent about a year kind of kicking the lawsuit down the. They didn't really pursue the lawsuit right away. I think they really thought that we were going to pay them. Um, there's a lot of irrationality, not clear information, bad communication. Um, but the what we had to start figuring out was like what were our options. And I mean, I think it's a few things that there's very few people you can go to in these types of situations. Like we got bad advice from lawyers, especially big
Mhm.
law firms. They don't
Mhm.
understand these options. There's very few people who understand these restructuring. So you really need to come to somebody who really understands these restructurings and has seen them up to.
Yep.
And there's a few things. Like number one, the idea was what we were trying to figure out was how do we keep the company going? We still believe in the company products were still selling through all these problems. Customers were still insanely loyal. Like, so how do we keep this going? This is clearly something that has value. We want to retain the value out of it in some way, shape, or form. So
Right.
we looked at first, a Chapter 7 is a there are two types of bankruptcies. There's a Chapter 7 and a Chapter 11. Almost everybody thinks when they think bankruptcy, they think Chapter 7, and that's the shutdown. That's the wind down.
Right.
Most small companies, that's not really an option for you.
Right.
Chapter 7s are for big companies that have tons of
That's like you want to
assets.
close up shop and just end it, right? And kind of
Yeah,
distribute
you
the
want to
assets,
end it.
which
Yeah.
right.
And you do it neatly with a bow so that there's no lawsuits
Right.
or anything like that. And again, it's a very expensive legal process because you're negotiating with lots of creditors, things like this. And so this is for big companies. This is for like $100 million companies. You do not want to do that
Well,
as a small
Chapter
company.
7 is actually lower cost than Chapter 11, but again, it's designed for just closing shop and going away, which is usually not what you want to do. You're going to lose everything, and it doesn't resolve personal guarantees, by the way, either. So that
No,
leads
it
you to
doesn't.
then Chapter 11, right? Which is a
Chapter
little bit,
11,
yeah.
Chapter 11 is also called a bankruptcy, but it's not a shutdown, it's a restructuring.
Right. It's a
And
reorganization restructuring, and that's the one
And
where
that's a
you kind of
there's a
sorry.
big misunderstanding around that because a lot of people hear Chapter 11 and they think it's a shutdown or that the company is not going to be able to keep operating, and it's in
Exactly.
fact the exact opposite. Like the court
Right.
mandates that the company keep operating because it has to retain
Exactly.
some level of value. When you look at a Chapter 11, you have to between a Chapter 11 or a Chapter 7 basically shut down or restructuring. Does the company have enough value to keep going? If you were to like say just get rid of some of these debts, like for us it was just getting rid of the lawsuit. If we got rid of the lawsuit, we were a perfectly viable company.
Right.
And so it's the same thing if you have like if there's one or two debts that are really bringing your company down, and if you could just reorganize those debts or get rid of them,
Right.
or get rid of a lawsuit, and your company is viable, then that's when a Chapter 11 is really a viable
Yeah,
option.
but the one problem with a regular Chapter 11 is that you lose all of your equity typically. The
Well,
equity gets wiped
not
out.
necessarily. What happens, the reason that happens a lot of times is because the Chapter 11, from what I understand, Chapter 11, you can keep your equity. That cap table can stay in shape, but the creditors have a lot more power in a regular Chapter 11. So if the creditors see, and on the creditors form a creditor committee on Chapter 11. So everybody you owe up money to on the Chapter 11 forms a committee, and they get to vote on things. And if they see that the cap table is staying in place, and but they're getting screwed and they're not getting paid,
Exactly.
then they will push to have the equity wiped out, right?
Right.
Um,
Right.
this is why a subchapter 5 is a lot more valuable. And if we can get into like the chapter 11, again, is only for big companies. And if you talk
Yeah.
to like a major law firm, they're going to tell you as a small company, you can't afford to do a chapter 11, which is true. You cannot. And it doesn't make sense. But this is why Congress created a subchapter 5, which is a form of chapter 11 for small businesses. Typically, it's been for companies that have less than $3 million in debt. Briefly during COVID, they increased that debt limit to 7.5 million. And there's legislation in place right now that may pass that will bring that back up to 7.5 million.
Yeah, right. That
So,
subchapter 5 is really what the interesting thing is. Before we move to that, let's just run through these other kind of options that
right.
people often look at. ABCs, which I understand, as I understand it, is a state-based action. It doesn't necessarily
Yeah.
wipe out federal claims and things like that. It doesn't wipe out necessary lawsuits. It's another way to kind of dissolve typically the company and give the assets away to the creditors. Correct?
Well, the ABC it's an auction essentially. Essentially, it's a controlled auction. Um, so an ABC is a great way. So the equity will get wiped out in ABC. In an ABC, it's an asset base for creditors. You take the assets of the company, and it's a controlled auction that needs to be controlled through a professional process where you try to sell the assets of the company to the highest bidder.
Right,
And
and then the proceeds are distributed among the creditors
creditors, right,
in order of
right,
the priorities, right? And then the Article
right,
9
and
is,
seniority.
of course, a little bit more focused on lenders and a way for lenders to get control and sell the asset and wipe out junior liens, correct?
Yeah, that's correct. So like a senior lender can take control of the entire company at some point with an Article 9. So in these situations, if you're a small company, like if you have a stalking horse, if you have somebody, who wants to buy the company and can keep it going, an ABC might be a good option if you have the money to run the process. And if the process is done correctly, the creditors can't really have a complaint about it. Um, there's been a few ABCs recently with certain I think Foxtrot went through an ABC, and then you have an Article 9, like if you have say an investor or a friendly lender or something like that who you think will keep the company going. This is something that you can do and work with an Article 9 to try to keep the company operating by having one of your lenders take it over and become the majority stakeholder at that point. The key
Right.
with both of these things is that the other creditors who don't get paid or don't get paid much out of this, need to under need to you need to prove to them that this is the best possible outcome and that they're not going to. That way, they don't have any. They won't take any claims against the company saying that they got screwed. Um, and then, of course, there's
Then
out of
there's, of
court
course, that.
restructuring.
Yeah.
Yeah,
But
which is where you just negotiate directly with all your creditors
that's
and
right.
try to negotiate things down, which is the first thing anybody should
Which
do
is the first thing you
before,
ever
because
usually tries, and you tried that too, but you couldn't get anywhere with the party.
right, the candy company that filed
Right.
the claim against us, like there was nothing we could do about it. Like they would not negotiate with us. We spent over a year trying to negotiate with them.
Okay.
Didn't
So
go
let's get
anywhere.
into, guys, we're in the interest of time, let's get into some of the pros and cons of the subchapter 5, uh, and talk about it a little bit.
So like a big pro is like, typically founders keep their equity in a subchapter 5, and that's because there's not
That's
a
right.
creditor committee. A creditor committee is not formed. Um, so the equity is not wiped out, and the creditors don't have as much control over the plan and and the restructuring finance as they do in a regular chapter 11. In a regular
Right.
chapter 11, the creditors can shut down things if they don't like what they see happening.
That's right.
Um, the court can, when you go through these chapter 11 processes, what happens is,
Yeah.
you go into a court, and in a regular chapter 11, the trustee takes over running the company. In
Right.
a subchapter 5, the CEO or the founder or the board can keep running the company. The management keeps running the company. So that's
Right.
another benefit. Like I kept running the company through the entire time. We have a trustee, but the trustee is just basically there as an advisor.
Yeah.
And I just submitted cash flow reports to the court every month. And if we needed to do something like take a loan out for financing for working for inventory, like we just needed to get the court's approval and these types of things.
Right.
And then the court gives us a date to submit a plan. We submit a very conservative financial model plan. This is not a time to try to be to show hockey stick growth. This is a time to be very conservative with your cash flows to show that you can prove that you are a viable company and that you can operate and have positive cash flows, or at least at break even, while negotiating down a certain amount of the debt. And the court can approve this plan. Then the court sets a date to approve the plan. The judge can just approve the plan without creditor input. Now, creditors can vote on, they do vote on the plan. And so that does help the judge's decision, but the judge can still pass. If the judge likes the plan and you have a crazy creditor who's like, no, I want to get paid full amount, the judge can say, no, that's ridiculous. And this is a good plan. We're going to go forward.
So it
Whereas
seems
in a
like this
regular
is
Chapter
it's
11,
purpose built for smaller businesses and it's a lot lower cost than the typical Chapter 11s, right?
a lot lower costs. There's no court fees. The legal fees are much lower. You're looking at like $30,000 to $60,000 in legal fees, assuming there's minimal problems. And where full Chapter 11 is like over 100K for legal fees typically.
Right. And the
The debt
big
was
news coming
restructured for
down
manageable
now is
FF.
that the debt ceiling,
Yeah,
the limit to get into a chapter, be qualified for a Subchapter 5, which used to be about $3.4 million in total liabilities, is now being raised to 7.5 million. So it opens the door up for a lot more companies.
exactly. Which I think is good. I mean, I think it should probably be a little bit higher, like maybe 10 million.
I
But
agree. I agree. It makes no sense.
yeah, so the debt ceiling is a problem. It's a challenge for some companies right now. Um, the debt is reduced and stretched. It's not really erased. You do need to, when you go into a Chapter 11, Subchapter 5, do need to assess the viability of this, which is one of the
Hmm.
key thing that the court looks at is, um, you know, also the other thing is like it has to look at the amount of debt that's out there and look at the assets. And
Hmm.
one
Hmm.
thing that can prevent your plan from going through and the company keep operating is
Hmm.
if you have like 100, just throwing these numbers out there, but if you have $100,000 in debt and you have $500,000 in assets, like viable
Hmm.
assets, then the
Hmm.
court might just say, hey, just sell the assets. Let's shut down the company, sell the assets, and pay off all these creditors 100%. Right. But like for us, like the total amount of the debt was way above the total amount of the fixed asset or the fixed inventory at any given time. We don't have any fixed assets, et cetera, like that. So it was clear that the best way for any creditors to get paid anything is for the company to keep operating and create create cash from operations. So you want to prove that the best path forward for the company is to create cash from operations to pay the creditors something.
Yeah,
Um,
that makes sense.
typically the creditors that don't get paid full amount, which would be your class. There's four classes of creditors in Subchapter 5. The class
Right.
3 creditors, which are your unsecured creditors, are
Yeah.
usually the ones who get paid the least, and they're the ones that typically get paid. The average Chapter 11 or Subchapter 5 pays 10 to 15% on the
Mhm.
dollar. And it is for over 3 to 6 years. So,
What was the low point for you, Abe, as you went through this?
I mean, I think rolling up to the Chapter 11 and having to actually do it, like we kept talking about, we spent months preparing for it. You do want to spend months preparing. This is not something you jump into like overnight. You want to
Yeah.
set a date out there, and you don't say, okay, we are going to file Chapter 11 in 6 weeks. Like you say,
Yeah.
this is the date where we might file Chapter 11 if X goes wrong, right?
Right.
Up
Right.
until that point, you try to avoid it. I mean, and you need to prove that all the time because you don't want to, like, say, enter into a contract with somebody and, by accident they get screwed or something like that. The other tough parts about Chapter 11 is the fact that nobody understands that it's a restructuring and that you keep going. Everybody hears the bankruptcy and they assume you're shutting down, things like this. So you need to communicate a lot with your vendors, employees, customers, everybody that is critical to the operations of the business, that no, we can keep paying you. We can vendors, critical vendors, or contract vendors. Sometimes I've heard them called critical vendors, contract vendors. They're class four creditors in this, and they get treated differently. You're allowed to keep paying them if it is critical to the operations of the business and you have a contract in place. Employees have to get paid. Government taxes have to get paid. Any government licenses and fees have to get paid first. Like all those things keep getting paid in any type of situation with the Chapter 11, Subchapter 5. And so the business has to keep operating. That is the most important part of this. And people need to understand that. And so you have to keep communicating that with everybody who is important to your business. And then
Let's
but the worst thing is certain things will just get shut down for you. Like we lost access to credit cards. Like, our company credit cards got shut down.
yeah.
We can't get them back. Things like this because people just see Chapter 11 and there are certain, we were using certain financing for inventory financing. They just shut us off. And we had to find private investors to fund financing after that because who understood Chapter 11s because there are certain fintech companies that just have this irrational rule that if you've gone through a Chapter 11,
Right.
they will not fund you.
It
So
seems like the amount of knowledge you have on this, Abe, is incredible. I think you can be a real source of guidance and help to other founders who are dealing with some of these issues out there. Hannah, do we have any questions or anything that we want to address?
I think you covered most of it. Yeah, I think Nick, it would be helpful to hear from you about how NP Capital can help founders navigating this process.
Yeah, I think from my perspective, we look at a holistic approach when we get approached by founders and others in these kinds of challenging situations. Article 5 makes sense for some in some situations. It doesn't make sense in some situations. It's really important to look at the totality of the situation and then figure out which option is best for you. And it's also best to not rush into one or the other. We'd like to keep maximum optionality because until ultimately the outcome has to be what I call that new money event. So there has to be either someone putting in additional capital or someone, buying the company or some transformative event that's going to help take the company to the next place. And it's often good to make sure that you're aligning with the party that's going to be providing that new capital or the buyer, whoever it may be, in choosing which path you go down. But look, I mean, right now, CPG is such a working capital intensive business. The story that we've just heard from Abe today, it's a very common story, whether it's for an issue of a lawsuit. We have another client that got faced with one of these class action type lawsuits that unfortunately a lot of CPG founders get hit with. We have other clients who are facing issues because of their working capital cycle, or a vendor comes along and decides that they want to get paid faster. Customers start paying slower. Founders in CPG, especially in CPG, smaller businesses get squeezed in the middle. It's really, really challenging because their vendors are typically bigger than them and their customers are bigger than them. So on one side, you have like Walmart and CVS and UNFI and all these guys, right? And we all know the payment tactics of these distributors, stretching 60, 90 days, taking crazy deductions. You think you're going to get a check for 100,000 and shows up a check for 54,000. You're like, where the hell did the rest of the money go? Right. And these kind of issues cause real and day-to-day cash flow difficulties. And that's one of the biggest things that NP Capital is really an expert at, is helping you map out your cash flow, helping you improve your cash flow dynamics. And then helping you, if needed, to find a ultimate long-term solution for how to take the company, out of this kind of, this cash challenged, place, and into a place where it can grow again. I really want to thank you for your time today in explaining your story. It's a really, really good story for founders to hear and to learn from. Hannah, thanks for helping moderate this great podcast. And we'll see you next time on our next. I think we have a big series coming up on Cash Me If You Can. It's a three-part podcast series talking about the flow of capital from the outgoing of the part of the cash cycle where you pay for goods and create the AP all the way through, creating the goods, following it all the way to the shelf. And then the customer buys the goods, pays you generate AR, and then ultimately collect the cash. So it follows out the cash all the way in from the dollar you spend to the dollar you receive. And what elements, take place, what things take place along the way, and where there could be potential improvement. So it's a really interesting series, I think, for founders.
Definitely. Yeah, definitely tune in. If you want to reach out to Nick, Abe, and the team, you can reach them at info@npcapitaladvisors.com or go to the website npcapitaladvisors.com. They're doing a lot of great work and are super helpful to founders in this space. So stay tuned for the Cash Me If You Can series, and thank you so much for your time, both the audience and Nick and Abe.
Thank you.
Thanks, Al. Appreciate you.